Welcome back everyone to another episode on Ang's stock review. Today we will be looking something similar, or actually we mentioned that we want to talk about, which is IBM, International Business Machine Corporations. It was during the review of IonQ whereby I want to talk about IBM because it's one of the competitors towards it. So without further ado, let's get right into it. So over here we can observe for the price for IBM. It has been searching up. By the way, this is the weekly chart, and it is similarly in a uptrend whereby since the COVID drop, it has been going up about 170 or 180% more. So I do think that the price actually reflects the ability of the company, which able to provide cash flow as well as profits. But that's only just based on the price action. Without further ado, let's get right into their financial fundamentals. So over here is the revenue for IBM. And from the observe of the value, the quarterly revenue actually is in the form of decreasing, as it is actually quite concern for me due to the fact that their sales or what they are doing are slightly in terms of providing less returns or less revenue, which might directly affect their net income. So for their net income is kind of expected, whereby from the decreasing revenue, the amount of their net profit shouldn't be higher than their revenue, and also in a very decreasing form, as well as very low predictability in terms of being able to generate cash and profits from this company. Whereas for the free cash flow of IBM, it's still in the form of positive. It's just that the free cash flow value has been decreasing since the year 2011 and just decreasing all the way. So let us get to know what IBM actually do. Is that it's a large diversified technology company, historically known for its hardware, but recently has shifted heavily towards software, cloud, consulting, as well as AI. So for their revenue streams, most of them, which is 43%, actually come from software, 33% from consulting, 22% from infrastructure, and 1% from financing. So the strengths of IBM is that they have strong hybrid cloud and AI capability, whereby they have cloud strategy, which many enterprise favor. AI capabilities like Watson and data automation tools position it well to capture the growing AI-driven market. And second of all is stable free cash flow and financial strengths. So they generate 12.7 billions. And thirdly is going to be their diversified business model, whereby they do include in terms of software, cloud computing, AI sectors, infrastructures, hardwares, and financings. So they don't just rely on a single product, and they also have provide multiple services across the world. The weaknesses of IBM is that it's lagging behind big cloud competitors. So compared to like AWS, Microsoft, and Google Cloud, so it's just very strong competitors. And second of all, it's going to be cyclical and declining infrastructure revenue. So their original business of hardware selling are not growing fast in the cloud world, and making this a less growth machine in the long term. And thirdly is going to be their consulting revenue pressure, whereby the consulting business is more sensitive to the economical cycles, and which can be less stable. So now we'll be looking into their ratios, but first of all, let's look at the uh, profit margin. So the profit margin is quite nice, is around 10%. And if you actually shorten the time period of the data, you can actually observe that the revenue is actually increasing, as well as for the net income is also increasing. However, in the long run, from 2016 until today, 10 years data, it's actually showing the fact that we are actually facing a decreasing revenue throughout the years, as well as decreasing net income. It has slightly recovered during after the year 2022, slightly recovered, but whether or not if it will actually continue to make growth in terms of their higher net income, or it will just consolidate or eventually decrease even further, which can be one of the deal breaker towards long-term investment, as it no longer provide that high quality features that being able to provide high net income back in the year of 2012, which generate almost 5 to 6 billions of quarterly net income. The result is also can be reflected by the price action itself. So during the year of like 2012 until 2022, which the net income and revenue is in a decreasing form, it actually is being reflected in the price action of the stock price, whereby it just decrease. And after the year 2022, whereby they starts to show slightly recovery of their revenue and net income, and then the price actually reacts to it and break through the all-time high. But the price action of this just does not it concerns me because due to the fact that despite having the revenue or net income recover from the previous low, they are still lower than what they are being able to provide 10 years, 15 years ago, and yet the price of the market still goes up. So in this situation, people are just buying the news, buying their expectation as well as future potential of this company rather than being reflected through the data. Yes, it's being recovered, but it's just that it does not have the strength as it used to be. And moving forward into the future, what concerns me is that will this hold longer? Will the price still be able to go higher while there are risks whereby the net income or the revenue of the company may not be able to maintain and even go lower? However, if the company is being able to do better and there is a better case, and at the end of the day, despite all the possibility which is biased towards bullishness, such as, for example, let's just take it that the company is actually doing well, the revenue and net income are expected to recover back to their previous 10 years ago data, which is similarly high value, high net income. The price of the stock is still at a very high, which is staying at the all-time high, whereby I wouldn't actually want to invest right now due to the fact we have very little safety or margin, and I would like to know I would like to have the opportunity to buy it at a cheaper price or below the intrinsic value so that I can have more space profits. So moving on to the balance sheets, we have the total current assets at 32,000 as well as total current liability at 35,000. So slightly missed, but I do think that it's still being able to cover up quite nicely. It's just that it does not have being able to cover up 2 times or 3 times more. As for their net cash, is in a negative form whereby they have more debts than their cash. Looking at the ratios, we have P ratios at around 35, which is quite reasonable, but at the same time, it's also slightly overvalued. As for the PB ratio, is definitely higher than the median, and for the debt equity ratio is above 1, which is standing that the company has a very high debt situations, and as well as their ROE of 30 higher, better than the 15%, as well as ROIC in increasing form, although it's lower than 15%, but reaching that 10% is quite decent. Finally, we'll be looking at the economic mode score for IBM. So we have the Guru Focus rating it at 7 out of 10, entry level white mode, and also have alpha spreads, having a narrow economic mode. Mode Boy, 3 out of 5 as narrow mode. Morningstar assigned IBM as narrow mode, and the mode score analysis provided by this AI itself is staying about 7.5, so it's rating it actually as more to moderate or entry level white mode. So overall, this company is a well-known company, being able to provide a lot of services in terms of wide range in hardwares, their software, including clouds and AI system infrastructures, and small percentage of financing. However, I wouldn't consider to invest long term in this company. So the price reaction is great. You could have made a lot of money out of it. It's just that the data does not makes me comfortable, whereby the revenue and net income is in a decreasing form. There will be potential whereby in the future they will be able to provide better growth as well as recover their net income to back to their originally, whereby they will be able to provide more, and they have more debts, as well as the mode score of the company is sitting around entry level or narrow moderate mode, whereby there is uncertainties in terms of the mode decisions. So in this states whereby when the mode score by different analyses are different, so I will actually take it as a moderate mode. So at the end of the day, this company with high debts not ideal results in terms of net income as well as undecisive mode, I wouldn't actually want to risk my investment capital into this investment, as there are more opportunities. If we want to have a specific company, for example, cloud services, including our Microsoft and Google as well as Amazon, which has better services and more profit margins in terms of their cloud services. So I guess that is all for IBM. It's a company definitely better than IonQ. However, there are still space for discussion whereby whether or not if this is a better investment for you to actually get right into it, or there are more other than this, such as Google and Amazon. Well, my take is that I wouldn't actually invest it right now due to the fact of the decreasing revenue and net income in a 10-year scale. So as a result, I would want to observe first, because IBM is actually a very popular company. So it's actually quite a waste, but then the data from itself explains that there are better options out there lah. So I guess that is all for today's video. I hope this helps, and if you are interested in this company, do your due diligence, further research on it before you invest your money on the company. So I guess that is all for today's video. I'll see you guys on the next one. Goodbye.